Is it truly harmful to invest in cash during these challenging economic times? Despite the market volatility caused by COVID-19 and the Russian-Ukrainian conflict, Bridgewater Associates' Ray Dalio maintained his opinion that cash is not the place to be. Cash is not a secure investment and is not a safe spot to keep money since it is taxed by inflation. Having a safe, well-balanced portfolio is especially critical during tough conditions. You can lower your risk without lowering your rewards. We should be aware of the present inflationary climate and stop considering cash to be a secure investment. Hey, don't get blindsided because in this video, we will go through some of the details behind Dalio's hallmark, cash is still trash, and to cope with it. So, let's get started. Cash is still trash. Why is it the case? The stock market recovered quickly from the pandemic low in March 2020, owing to substantial fiscal and monetary stimulus measures undertaken by the government and the Federal Reserve to bolster the economy. Yet, the system's abundant money supply may cause various economic and political issues. Because of the creation of money and the purchase of debt assets, interest rates have fallen to such low levels that cash and bonds are becoming terrible bets. In addition, you can't enhance living standards by increasing the quantity of money in the system's credit, since that simply means more money hunting the same number of products. It will have the expected effects on financial markets and the inflation rate, and it will not significantly increase living standards. When asked if cash is still trash, a hallmark remark that Dalio has made multiple times, he answered it is because interest rates aren't yet high enough to perfectly balance the impact of inflation. The genuine utility of money, on the other hand, is determined by how it compares to others. What are our options? The thinking must shift so that everyone considers the returns in real terms. In other words, inflation adjusted since you're attempting to save purchasing power. If you have an asset that has essentially no return and is not volatile, but suffers from inflation, you have to consider looking at it and simply underweighting or underusing that cash. Consider reducing holdings of cash and bonds in dollars, euros, and yen, and/or borrowing in these currencies and starting to put funds into a broadly diversified portfolio of assets, including stocks and inflation hedge assets, particularly in countries with good finances. As per Dalio, investors are advised to keep their investments very well diversified in terms of currency and region. Aside from diversification, Dalio believes that liquidity and differentiation should be the focus of investor portfolios right now. According to him, liquidity gives an investor the ability to alter when circumstances change. Dalio also advised investors to distinguish corporations and regions that are neat and tidy and will succeed in this climate from those that are liable to bankruptcy and turmoil. The degree of disorder in a corporation or country is determined by the entity's revenue compared to its costs, as well as its assets to liabilities. Investors will be able to detect dramatic variations in financial implications. Finally, remember that who lives by the crystal ball is destined to eat ground glass. So, tell us what are your thoughts on this? Share with us your thoughts by leaving a comment.